My name is Mark Rudovic, head of real assets at Hodes Weill. And today I'm going to discuss the findings of Hodes Weill's inaugural infrastructure allocations monitor, which was published earlier this year. So the report is an annual survey designed to assess institutional investor allocations to objectives in infrastructure as an asset class. And this report was done alongside our academic partner, Cornell's Program in Infrastructure Policy, CPIP. And it really builds upon the success of the institutional real estate allocations monitor that Hodes Weill has been conducting since the beginning of 2013. So the findings of the 2023 report are based exclusively on data collected from 63 institutions across 16 countries, and this represents roughly 6.8 trillion of assets, of which approximately 325 billion are infrastructure assets under management. Getting to some of the key findings of the report, globally, institutions are underinvested in infrastructure by an average of 98 basis points. And that's across all institutional investor types. And looking further into the data, this underallocation is most pronounced in North America, where institutions are underallocated by roughly 152 basis points versus targets. So many institutions have been forced to reassess their allocation plans in 2023 as kind of the strong performance in infrastructure portfolios coupled with underperformance in public equities, fixed income, and other private markets asset classes has brought investors closer to target allocations. And looking forward in the next 12 months, roughly 43% of investors surveyed indicated that they plan to increase target allocations to infrastructure. I feel like one of the more interesting sections of the infrastructure allocations monitor was the assessment of historical and target returns. And it's an interesting section for investors looking to solve for benchmarking issues, which has really plagued the asset class since inception. And when you look at the 3-year average return across all institutions being 10.7%, it exceeded 2023 target returns for the asset class of 9.4% across all institutions. And I think this is a really meaningful data point because it reflects both the criticality and resiliency of the asset class. In what's been, let's face it, a turbulent 3 years when factoring in COVID-19 related lockdowns, supply chain pressures, an increase in inflation rate, an increase in interest rates, and heightened geopolitical tensions. And one of the key characteristics and main attributes of infrastructure within a broader portfolio is its ability to provide inflation protection. And I think that really comes through when analyzing the 2022 performance figures. So infrastructure portfolios returned roughly 14.4% in 2022 compared to 6.9% in 2021. And I think that was really driven by the inflation participation that was afforded in the asset class. When thinking about 2022 being a year where CPI finished the year at roughly 6.5%, the highest level on record since the early 1980s. So infrastructure as an asset class did what you expected it to do in 2022. So I think that was a very positive data point. Our survey asked investors how much capital they plan to invest in 4 key infrastructure verticals in 2023 compared to 2022, with the 4 verticals being digital, transport infrastructure, social infrastructure, and energy infrastructure. And out of these 4 segments, interest was greatest in digital infrastructure, with roughly 34% of respondents indicating an intention to allocate more capital to digital infrastructure over the next 12 months. Digital infrastructure and other connectivity infrastructure shined during COVID-19 related lockdowns and has benefited significantly from hybrid work environments. And not only that, it's been one of the main beneficiaries of the rapid emergence of new technologies in 5G, the Internet of Things, AI, and things like edge computing. So we asked investors to dig a bit deeper on the energy vertical, just given the sheer size and scope of this ecosystem, where you have sectors like LNG, midstream, power generation, and even within power generation, you have different generation types like solar, wind, and gas. And there we wanted to find where interest lies at a more granular level. And the conclusion was that energy transition remains the preferred sector of interest. Compared to 2022, 40% of respondents indicated that they plan to increase allocations to renewable energy and storage, which was slightly more than any other energy subsegment by a slim margin to quote unquote new energy transition, which encompasses asset types such as carbon capture and green hydrogen. Interestingly, within that same survey question, we discovered that roughly 76% of institutions reported that they are either not investing or investing less capital to oil and gas. And the only region where investors plan to allocate more capital to oil and gas is in the Americas, with roughly 7% of respondents saying that they will invest more to oil and gas. Globally, institutions continue to gravitate towards higher risk, higher returning core plus and value add strategies. Institutions are favoring higher returning strategies as portfolios mature, and a rising interest rate environment impacts the relative attractiveness of core and super core type offerings. And then from a geographic standpoint, institutional investors globally are planning to grow allocations to North America infrastructure opportunities more than any other geographic region. And this growth in North America is really expected to be driven by things like the Inflation Reduction Act of 2022, or the IRA, which is a first of its kind legislation and the single largest investment in climate and energy in U.S. history. Well, I think in summary, the systematic risk plaguing private markets allocators over the last, call it 12 to 24 months, has had a minimal impact on the sentiment towards the asset class, despite this limited investor activity. And we view this positive sentiment largely being driven by the resiliency and performance, which I touched on, in the face of supply chain pressures, geopolitical tensions, rising inflation. And I think going forward, outlook for the asset class and demand for the asset class will remain robust across institutions globally, across various institutional investor types, whether it's a public pension, endowment, insurance company, et cetera. So the data and the trends by region, institutional investor type will be very interesting to evaluate this time next year. And I welcome all that are viewing this today to reach out if you have questions on the data or questions about some of the takeaways, want to discuss some of the takeaways. There's a whole host of information we have made available, and we have the report widely available on our website for both investors, managers, other stakeholders to reference. So thank you, and look forward to discussing the results again next year.